Hello, everyone. My guest today is Steve Arnold. He's been working with a team growing it fast around his company called eDays, an absence management software. Leading the commercialization and growth of their award-winning global employee leave tracking and absence management solution. He led them from startup phase to their current market-leading position and securing private equity backing to further accelerate the growth. Steve, ready to take us to the top?
Yeah, let's do it.
All right, so just to be clear, is this your baby? Did you found the company or you joined later?
Yeah, I joined, and a friend of mine had a company that was specialized as a web agency, and I joined him in order to grow that company. And then we started eDays as a product within that company. So I've been with eDays from the start, although there was a pre-existing company within which we incubated the product.
So what was day one for eDays? What year?
2007.
Okay, 2007. Now today it's its own private company?
Yeah, we carved it out in March 2016 as its own legal entity, but we'd run it as a separate company division within this other parent company that we had at the time.
Okay, let's talk more about that later. But first, give us product context. What's the company doing? How do you make money?
Yeah, sure. So we're a specialist HR solution focused on absence management. So that's leave tracking and absence management. It's a business solution. In terms of how we make money, it's a subscription model. So it's per person per year fee or per month fee, but we bill annually up front. The value proposition is really it helps companies be super efficient in this area, which most companies need to run some sort of process to manage employee leave and time off and absence. eDays does that really well. It helps them be compliant to the local rules. It's used globally, so it can be customized for different parts of a different company based on what requirements it might have. And if used properly, it'll reduce the absenteeism within a company. So
Steve, is this more kind of enterprise level? What's the average company paying you per month for this?
Well, it's a real range. So we've got some companies that are paying us as little as $50, $100 per month for the system, but we've also got our larger sort of mid-market enterprise, I'd call them, companies that are paying $6,500, $7,000 per month. I'm using the numbers in dollars rather than pounds to make it good for your audience.
Thanks for doing that. Yeah, so just because we don't have time to go on every cohort, I mean, so what would you say a fair average is if you look across your entire base right now? 1,000 a month or what?
An average customer has got about 150 employees and they're paying about $200 per month.
Okay, 200 per month and 150 employees. So you're really only charging like $1.20, $1.10 per employee, something like that?
Yeah.
Interesting. Okay, very good. So launched in 2007, spun it out in 2016. Walk me through that process. Is the parent company on the cap table of the new entity?
No. So in March 2016, I basically sold my interest in the other company, which I had negotiated with the founder of that company. I sold my interest in that and just retained eDays. The other partner that I had at the time, the founder of the parent company, came with us to the new business, the eDays Absence Management Solution System Company. And then I bought him out in November 2017 with private equity backing. So the previous company is no longer on the scene.
Okay, interesting. All right, and so over the time period from 2007 all the way up to today, how many customers have you scaled to?
We got 1,400 customers now.
Okay, and is there a free plan or no?
No free plan.
Okay, so 1,400 at $200 a month, you're doing about 280 grand a month in revenue?
Yeah.
Okay, and where were you exactly a year ago so we understand growth rate?
So it was quite slow to begin with because we were incubating eDays within this other parent company, and our focus really was on that other company at the time because that was the one that was making us the money. We didn't get any outside investment to fund eDays, so it was all organically funded. So it was quite slow to begin with. It took us about 10 years or 9 to 10 years to get to 1,000 customers. And then over the last 12 months, we've signed up another 330 odd customers and added about dollar value, about £600,000 worth of recurring revenue on the business over the last 12 months.
Okay, so if you're doing today $280,000 per month, what were you doing a year ago? Was it 200 grand a month or what?
Yeah, it would have been about that. I'm trying to use convert to dollars again. So yeah, it would have been about that amount that you say.
So that would have been about 180,000 pounds per month.
Yeah.
Something like that. Okay, good. So not doubling year over year, but call it maybe 40, 50% year over year growth is kind of where you're at today.
Yeah, actually the numbers that you state probably a little bit inflated. So it's more about our ARR has grown about 30% over the last 12 months.
Okay. And so where are you today in terms of run rate?
So our recurring revenue is £2.7 million.
Okay, so we'll call it that's about $3 million, right? Divided by 12 months.
Yeah, about $3.5 million, I think.
Got it.
About it.
Good. So yeah, that's about 3.5. Yeah. You're right. Yeah. So I was right, about 280 grand per month in revenue, and then that's up from, you said 30%. So maybe you were doing about what, like $230,000 a month a year ago, something like that.
That sounds about right.
Yeah. Where's most of the growth coming from? What's the growth channel you're using?
So our direct market model is all fueled by, or our funnel is fueled by digital marketing. So we've got SEO and pay-per-click strategies to get people to our website. We get about 100, 120 inquiries per month. There's a bit of seasonality in there based on the months where we're a little bit busier sometimes towards the end of the calendar years and the beginning of the calendar years. So we get these inquiries coming in, and we convert 25% of those to customers. That's our metric that we've kept pretty consistent.
Okay, so what do you do? Walk me through the process. 120 new leads come in every single month. What's the next step between that and them writing a check or paying you for the first month?
Yeah, sure. So we've got a team of 6 sales guys at the moment. They're split into enterprise and SMEs. Enterprise for us is kind of a mid-market company, anything up from 500 people up to maybe 25,000 people. A large company's got 25,000. So we split the teams between SME and this sort of enterprise mid-market side because there's a different sales process that you kind of need to go through. But ultimately, what we're trying to do is have a conversation once that inquiry comes in very quickly, whilst people are still on the website, if possible. So we'll follow up an email form that's come through our website with a phone call. We'll engage with that customer, understand what their starting position is, what they're wanting, and we'll try and get them onto a demo, an online demo via screen share. When we get them onto an online demo via screen share, we've got a 50% conversion rate of people who see days to signing up with the system. So we run them through a demo. It takes about 40 minutes normally. We'll demo by a user and an HR manager. Often our buyers are HR managers or HRDs or payroll or finance type people. And then following that demo, they'll get access to a trial system, which we'll put their logo on, and we'll give them some pretend data in that trial system. Then we'll let them loose on it for a week or so. And during that week, we'll send them a few emails to try and trigger them to use the trial and see if they can use some of the advanced features. And then we'll get in touch with them during that week as well to try and see what they're doing and how they're finding it. And then we'll try and sign them up.
How many demos is a salesperson doing each week on average?
Probably 7 or 8 demos.
It's about 1 a day.
Yeah, maybe it's a little bit less for some of the enterprise guys because they.
And so walk me through kind of capital history today. So have you raised any additional capital besides the private equity?
No.
Okay.
All we had to do is raise funds to buy out my previous partner, essentially the business, and now we're just running into growth mode.
Okay. And so how much did you have to raise to do that?
It was about 10 million.
Okay, about 10 to buy them out. So your partner had what, like 60, 70% of the company?
He had more than that. He had there were two of them really. One was a silent partner, so one of them had, in total they had 80% of the company.
Got it.
Yeah, and then there was another guy who was running it with me who's still here, who's our CTO, Chris, and him and I shared the rest of the company. And then since the buyout, we've kind of rejiggled the numbers with a private equity firm and made it really interesting.
So does the private equity firm now own, obviously, if they own 80%, you're still in the same situation you were before. Do they own less than 50% now?
Yeah. No, sorry. They own about 60%.
Okay, this is interesting. So this is almost like a reverse search fund model, like, right, where you actually had the company is spun it out. I don't know if you're familiar with search funds, but that's what this feels like to me. So you were essentially valuing the company, you were at $3.5 million run rate. I mean, you were valuing the company at basically $12 million, right? Or about 3-4x when you decided to buy them out.
Yeah, it was about that. It was really us going to market to find a private equity company who wanted to get involved with the management buyout. And then it was down to us making sure that we had the right numbers for the guy that we wanted to move on, making it sensible for him. It wasn't a hostile thing. It was a very friendly situation. It was different times of our lives. 20 years older than me.
By the way, he's getting paid $10 million. It shouldn't be hostile. He should be on a yacht somewhere.
Yeah, exactly.
All right.
Exactly.
What's the team size today? How many people?
So we got 30 people.
Remote?
Everyone's in this one office that I'm sitting in here in Nottingham, which is right in the middle of England. There are 4 new starters this month, which takes us up to 30. So one of those guys is actually a CRO. our first CRO. So I've been kind of running the sales division as well as a lot of the other things you do, I guess, when you're in this situation. But hiring the CRO, his task really is to take our sales team up to about 20 people, including putting together an SDR team to do some proper outbound. We're also starting to partner with other companies. So we've got a really nice partnership in place with a large talent management solutions provider. We've got about 30 odd billion users of their platform, and they're selling eDays as a part of their HR solution, Cornerstone.
Okay. And are you operating at break even today or profitable?
We're profitable.
Okay,
yeah,
we're profitable.
Yeah, I mean, this is a different situation from a lot of the US companies. I think with UK companies, often, you've got a more of an eye on that profitability, and we're about 45% EBITDA margin.
Okay, that's great. So on just to be clear, that would mean on 230 grand or sorry, no, not 230. You're doing 290 a month. You're saying you're taking essentially every month. What would that be? $130,000 to the bottom line?
Yes, it's about £1 million a year. So
Yep.
that roughly about the same as what you said there. Yeah.
Yep. That's interesting. Very good. All right.
But what we're trying to do now, Nathan, is really not focus so much on that margin and really focus on ARR growth.
Yep.
So we're starting to load a lot more cost into the business. We've moved offices. We've got a really nice location here now. We're adding marketing team.
What's churn today?
So we've got net negative churn.
What's gross churn?
8% of our customers would be our logo churn. Say again?
Annually,
yeah.
And then when you say net revenue retention is greater than 100, how far above 100?
It's about 105%, 106%. But
Okay.
What we haven't had up to date is anything additional to sell to our customers. Now we're starting to widen the application so we can actually start putting more through the upsell route.
To be clear though, Steve, if you're churning 8%, you've got to expand that same cohort by 13% to get to net revenue retention of 105. Is that right?
Your brain probably moves quicker than mine, but it sounds about right.
Yeah. If you just take the cohort that signed up a year ago and you assume all of them say so 100%, but they don't, so you lose 8%. In order to make up that gap, you got to sell 8% plus an additional 5%, so 13% to get to 105 net revenue retention.
Maybe, although a lot of the customers that do leave, if we're looking at logos churning, a lot of those customers that leave are those little companies that don't actually make that much of an impact.
Oh, what's revenue churn, not logo churn?
Yeah, sorry, I was talking about logo churn.
What's revenue churn? It's lower than 8%, it sounds like.
Yeah, it's a lot lower. Lower. Because those customers that, I don't know that number off the top of my head, but the customers that are churning are normally the smaller customers.
Yep. What about growth? You said you're going to go all in here, kind of be more aggressive. What are you paying to get a new $200 a month customer?
Our average, took some notes on that one. Our average cost of acquisition in dollars is just below $2,000.
Okay, so 10-month payback?
8.5 months is how I calculate the payback. Yeah, lifetime value is really strong on eDays. I mean, companies seem to just stick on board for a long time. So, I mean, we choose a 5-year LTV average to calculate our lifetime value.
Yeah,
but it's certainly sort of 6.5 or so times the cost of acquisition.
That's great. Yeah, you said you took notes. Do you listen to the show?
So my marketing guy, this was arranged while I was in Mexico on holiday. So my marketing guys did this, and I was like, "Who's this Nathan Latka guy?" I'm so sorry, I didn't know about you already, but I'm going to tune in a lot because they were really cool. So yeah, I listened to a couple of casts about an hour before we had this call. So I thought I'd just make a couple of notes, see if I can try and keep up with you.
You're doing great, man. We're actually here about to wrap up. Congrats on the growth. By the way, any US expansion plans or no?
Yeah, I hope so. And we've got about 60 odd companies using eDays in the US.
Do you have a subsidiary here already?
No, we don't. But we've developed functionality to deal with the PTO situation that you have out there in the US, because it's a very different. All the countries in the world have different ways of managing what we do in our application, and so we had to go to the drawing board and sort of invent a system to deal with quite a lot of the different localization requirements. And the PTO side and the US side is kind of in the system now. So we want to try and see if we can get over the water there a bit more aggressively.
Yeah, very interesting. Would you consider using something or raising something like venture debt, non-dilutive venture debt to drive growth, or no?
Not at this stage.
Yeah, you just use it based off your cash flow.
Yeah.
Very good. All right, let's wrap up with our famous 5. Number 1, what's your favorite business book?
I read recently Measure What Matters, which is a John Durr book I really enjoyed. I also read Aaron Ross's Impossible to Inevitable, I think it's called. A couple of recent ones that I've read that I thought were great. In the early days, I used to read up a lot of the stuff from Bessemer Partners. That they publish. I guess it's not a business book, but a lot of good material that I read on there. And now I watch quite a lot of the blogs, the Sastra stuff, the OpenView Partners blogs. Those I find really useful.
Good. Number 2, is there a CEO you're following or studying right now?
Not really. No,
Okay.
I would tend to just read books and look at blogs.
That's good. Number 3, what's your favorite online tool for building the company?
There's no doubt at all that Salesforce CRM has been super efficient for us in growing this company and getting the data that we needed to scale.
Good. Number 4, how many hours of sleep do you get every night?
I'm pretty good at sleep, actually. Probably about 6.5, 7 hours. I've got a little 2-year-old, so he's sort of messing around with that a little bit.
That's good. So married with a 2-year-old?
We're engaged. We're getting married. Getting married in June out in one of the Greek islands.
That's exciting. Okay, 1 kiddo, and how old are you?
I'm 40, just turned, and 1 kiddo, 2 years old.
You're not getting married at Lindsay Lohan's beach club, are you?
I don't know. I don't think so. I didn't know she had a beach club, but
no,
if you can invite me, I'll come along.
I'm totally kidding. You wouldn't want to get married there, I don't think. All right, last question. What do you wish your 20-year-old self knew?
I think my dad passed on some great advice to me, which always kept me really on top of things and made me a very positive person. And it was really just to believe in yourself, trust your instincts, believe that you can do what you need to do, keep reading, keep investing in yourself and your own learning, and keep enthusiastic and try and bring that enthusiasm to other people. If you can do that, you won't go far wrong.
Guys, E-Days, believe in yourself. Spun out, or actually launched inside a bigger company in 2007, spun out in 2016. Now 1,400 customers paying $200 a month, so doing about $290,000 per month in revenue, up from $230,000 a month just about a year ago. So 30% year-over-year growth rate. They're very profitable. 45% EBITDA, taking about 130 grand per month to the bottom line. They did have to raise about $10 million about a year and a half, 2 years ago to buy out a founder and another guy that owned about 80% of the company. But now just Steve and his team building the company, 30 people in England, just brought on a CRO, 8% logo churn annually, doing net revenue retention of about 105% each year, spending $2 grand to get a new $200 per month customer. So 8.5 month payback period, assuming they assume about a 5-year LTV of about 12 grand as well. Steve, thanks for taking us to the top.
Thank you very much. Lovely to meet you.